Here's the point where coordination ends. We showed you how UK and Belgium absorbed what China and India dumped, $680 billion in less than 2 years. But capacity is not infinite. The UK cannot lever indefinitely. Belgium's custodial accounts have limits. Japan is caught between defending the yen and absorbing treasuries. When those substitutes reach exhaustion, when the coordination mechanism breaks, only one buyer remains: the Federal Reserve. Not because it chooses to buy, because the system offers no alternative. And once the Fed becomes the buyer of last resort for U.S. government debt, something changes permanently. The Treasury market stops being a market. It becomes a financing mechanism. Prices stop reflecting risk. They start reflecting policy tolerance. This is not collapse. This is transition. Episode 1. China exited. $630 billion withdrawn. Episode 2. India stepped away. $50 billion liquidated. 274 tons of gold repatriated. Episode 3. We revealed the absorption mechanism. UK levering to $750 billion. Belgium warehousing $370 billion through Euroclear. From the outside, it looked like adaptation. But that was not demand. That was borrowed capacity. And borrowed capacity exhausts. If this is your first time here, subscribe. Because what follows is where the pattern completes. When absorption slows, when auctions become harder to clear, the system faces a choice: allow price discovery, or replace the buyer. Allowing price discovery sounds neutral. In practice, it removes optionality. If Treasury yields rise to clear the market without coordination, mortgage rates spike above 8%. Housing construction halts. Consumer spending contracts. Regional banks holding long-duration bonds face mark-to-market losses. Capital adequacy ratios fall. Liquidity stress cascades. Federal interest expense explodes. With $36 trillion in debt, every 1% increase in average borrowing cost translates to $360 billion in additional annual interest. That crowds out defense, healthcare, infrastructure. Tax revenues cannot cover baseline obligations plus rising interest. The deficit widens. Debt issuance accelerates, which pushes yields higher, which increases interest expense, which widens the deficit. A fiscal death spiral. No government chooses that path voluntarily, so price discovery is prevented. And when natural clearing is prevented, artificial clearing is required. We need to identify who provides it. When economic buyers leave, China exiting $630 billion, when political buyers reach capacity, UK, Belgium, Japan stretched. When foreign demand shrinks, India stepping away. Only one entity has unlimited capacity: the Federal Reserve. This is the moment the central bank becomes the buyer of last resort. This is not theoretical. 2008. The housing market collapsed. Mortgage-backed securities became toxic. Private buyers vanished. The Fed stepped in, purchased $1.25 trillion in mortgage-backed securities. The intervention was described as temporary. 15 years later, the Fed still holds over $2 trillion in MBS. 2020. COVID disruption. Markets seized. Corporate bonds, ETFs, even junk-rated debt, everything freezing. The Fed intervened, bought treasuries, corporate bonds, bond ETFs, assets it had never purchased before. The balance sheet expanded from $4 trillion to $9 trillion in months. Each time the language was identical: temporary liquidity support. Emergency measures. Until markets stabilize. It is never temporary. Because once the Fed replaces a market, that market becomes dependent. Question: what happens if the Fed tries to stop buying treasuries once it starts? Drop your prediction. Once the Fed absorbs issuance, the system changes permanently. Because the debt must roll over. And if private buyers do not return at scale, the Fed cannot stop buying without triggering the very instability it stepped in to prevent. This is the trap. Stopping purchases raises yields. Higher yields destabilize banks and housing. Instability forces renewed intervention. So the Fed continues. Not because of ideology, because of feedback loops. Think about the structure. Debt keeps growing. Deficit spending continues. Debt must roll over. Old bonds mature. New ones issued. Private buyers will not return at sustainable yields. China exited. India insulating. Political buyers are at capacity. UK, Belgium, Japan stretched. So the Fed keeps buying. Not by choice, by mathematical necessity. Monetization becomes the default setting. Policy tools shrink to one lever. We need to examine what this forces. At this stage, the mechanism becomes visible. The government issues debt, Treasury bonds. The central bank creates reserves, digital currency. Those reserves are used to purchase the debt. This is not funded by savings. It is not funded by trade surpluses. It is not funded by economic growth. It is funded by currency creation. That is monetization. Not in theory, in mechanics. Monetization does not require hyperinflation to reshape the system. It works through erosion, gradual loss of purchasing power, asset price inflation, distorted capital allocation. The system continues to function. Grocery stores remain open, paychecks clear, services operate, but the value of claims diminishes, not overnight, not visibly, through steady, irreversible degradation. What cost $100 3 years ago now costs $115, then $130, then $150. Savings lose value. Fixed incomes lose purchasing power. Debt becomes easier to service nominally, but only because the currency has weakened. This is not collapse. This is transformation. We need to understand the system consequence. At this point, the Treasury market is no longer a market. It is a financing mechanism. Prices no longer signal risk. Yields no longer reflect demand. They reflect policy tolerance. The Federal Reserve sets the clearing price. Not through explicit targets, through standing facilities, repo operations, and balance sheet policy. This is financial repression. Savers earn less than inflation. Bondholders accept negative real returns. Capital is forced into riskier assets to chase yield. This narrows the range of outcomes, and once this structure hardens, reversal becomes impossible. If the Fed stops buying, auctions fail. If auctions fail, yields spike. If yields spike, the fiscal position becomes unsustainable. If fiscal credibility erodes, currency confidence follows. So the Fed does not stop. It cannot. The system has transitioned from market-based reserve management to central bank-sustained financing. That is not rescue. That is replacement. We need to examine the historical parallel. This pattern is not new. Japan. 1990s to present. Massive debt bubble bursts. Economy stagnates. Deflation sets in. The Bank of Japan becomes the buyer of last resort for government bonds, corporate bonds, stock ETFs. 30 years later, the BOJ owns over 50% of Japanese government bonds. It owns massive portions of the stock market. It owns corporate debt across sectors. Did it cause hyperinflation? No. Did it restore economic dynamism? Also no. Japan has been locked in low-growth stagnation for 3 decades. The Federal Reserve is following the same structural path. But there is a critical difference. When Japan monetizes yen, it affects Japan. When the Fed monetizes dollars, it affects the world. Every country holding dollar reserves. Every trade settled in dollars. Every contract denominated in dollars. All of it subject to the debasement. That is why the exits matter. Will the U.S. follow Japan's path, or will something break differently because the dollar is the reserve currency? Drop your theory. This transition does not announce itself. It appears as routine policy adjustment, balance sheet expansion without crisis headlines, standing repo facilities used routinely, quiet yield curve control language, emergency tools becoming permanent fixtures. These are not responses. They are admissions. Watch the custody hubs. When Belgium's holdings stop rising, absorption capacity is exhausted. Watch currency stress in allied economies. When the yen breaks or the pound cracks, forced sellers emerge. Watch the Fed's balance sheet. When it expands without a stated crisis, the hidden crisis has arrived. Watch emergency coordination behind closed doors. When swap lines open or liquidity facilities activate without explanation, the plumbing is breaking. These signals do not appear in headlines. They appear in the data. And once they begin to overlap, the illusion of market-based clearing evaporates. We need to understand what this forces. Once monetization becomes structural, capital reorients, not toward return maximization, toward control preservation. The question changes from which assets will appreciate to which claims remain credible. We can observe what major actors are accumulating. China stockpiles 1.5 billion barrels of oil, not for profit, For operational continuity under disruption, India repatriates 274 tons of gold, not for yield, for jurisdictional sovereignty. Central banks globally are net buyers of physical gold at record levels, not for interest income, because gold has no counterparty risk. States are converting claims into control, paper into physical, promises into possession. This is not speculation. This is observable behavior. And behavior reveals what the system is now optimizing for. Not growth. Insulation. We need to examine where this leads. Stage 1. China selling created pressure. Stage 2. India exiting removed legitimacy. Stage 3. Hidden buyers delayed consequence. Stage 4. The Fed replacing demand removes illusion. From here, the questions change. Not, will the system survive? But, what survives the system? Because once monetization becomes structural, assets reprice. Not overnight, not chaotically, but permanently. Claims weaken. Physical constraints matter more. Jurisdictional control becomes central. This is why physical assets are being repatriated at record scale. This is why parallel settlement systems are being built. This is why trust in paper claims is fracturing quietly. The next fracture is not about dollars versus other currencies. It is about paper versus physical. We need to examine that transition. The Federal Reserve does not choose to become the buyer of last resort. It is cornered into it. When coordination fails, monetization begins. And when monetization becomes permanent, the system does not end. It hardens. What breaks is not finance. What breaks is trust in claims. That is the threshold we are approaching, not collapse. Replacement. In the next episode, we examine where capital goes when claims lose credibility. Why gold is leaving Western vaults permanently, why physical assets are being repatriated at record scale, and why the final stage is not about currencies competing. It is about the nature of reserves themselves. Systems don't fail when enemies attack them. They fail when participants stop trusting them. China stopped trusting and exited. India stopped trusting and insulated. Now the substitutes are stretched to breaking. And when the substitutes break, the central bank becomes the system. That is not rescue. That is replacement. The pattern does not require your understanding. It executes whether you see it or not. And once you see it, you stop trusting prices. You stop trusting stability. You start watching capacity, because capacity is finite. And when capacity runs out, systems do not adapt. They transition. Flows don't lie. Welcome to Geopolitics of Money.